Welcome and thanks for joining us today for the fourth webinar, which is part of Pearson's Changing Perspectives author webinar series. Today, I'm very excited to be facilitating this conversation with two of our market leader authors, Jonathan Berk and Peter DeMarzo. Today's session is called Bringing Finance to Life via Interactive Finance Tools. For those who don't know me, I'm Erzsébet Csibi and I'm the Retention Marketing Manager at Pearson and organizer of this author webinar series, and I'm based in Hungary, by the way. Let me briefly introduce our presenters, the authors of our market leader title, Corporate Finance, which now will have the 6th edition coming out in July. Jonathan Berk is a professor of finance at the Graduate School of Business, Stanford University, and is a research associate at the National Bureau of Economic Research. And Professor Peter DeMarzo is a professor of finance at the Graduate School of Business, Stanford University too. He's the former president of the American Finance Association and the research associate at the National Bureau of Economic Research. We are very excited that you could join us today. And I think I'm talking on behalf of all the participants too, and also my colleagues. Just a quick thank you for my colleagues in the background who are making sure the webinar runs smoothly. And before we start, a little housekeeping. We know many of you are working from home, and as you know, from these kinds of conversations, we sometimes get some background noise. So if you could please make sure you're on mute to ensure everyone gets the opportunity to hear from our presenters. We have a packed agenda and a lot to get through over the next hour, but firstly, we'd like to thank those who have pre-submitted questions. We'll try to incorporate these questions into the agenda to make sure they are covered. However, as always, we'd like this to be an interactive and engaging session as much as possible, so please feel free to ask any questions you may have in the chat. The chat function is enabled, and we will try to answer them either on the go or come off mute in the question and A session, or if you are asked any questions during the presentation or after the presentation. The recording will be shared with you later in about a week's time. And if you're interested in getting a sample copy of or a demo of the author's work, of the tools that they are going to show, we will be in touch with you soon after the webinar on how to do that. Okay, so that's all from me now. I will pass things over to Jonathan and Peter.
Okay, well, welcome everybody. It's great to see so many people show up.
Yeah, this is wonderful. So I'm in California. Jonathan's in London. So good morning or good evening, depending on where you're located. It's a pleasure to be here and talk a little bit about the teaching. We like to do things we find that work well in the classroom, talk a little bit about the textbook and the motivation behind it. So we're looking forward to having a conversation with everyone here.
Okay, so Peter, how do we want to start? Maybe just start by briefly talking about the textbook and the 6th edition, and then talk about how we can make finance come to life.
I agree. Yeah, why don't you kick it off with your thoughts about why we got involved in writing a textbook in the first place?
Exactly, and why we wrote the 6th edition. And there was a time when every 3 years books just brought out another edition, and that's the way it was. But we're fast approaching the end of our time, we think. And so this edition, I think, is an edition that is a precursor, I think, is going to be the future of textbooks. We put a lot of effort into bringing the textbook into the modern age. There's a lot of interactive tools with the textbook. We'll use some of the tools here today. It builds on what I think of as the basic idea of why we think this textbook is the best textbook and why it's done so well, which is to think about finance as a whole, to think about finance as a paradigm based on the absence of arbitrage. And so that's still the same way in the book. The big step forward, I think, in this edition is to really think of ways of communicating to the younger generation who are much more focused on interactive tools, much more focused on online stuff, much more likely to use an online book. And so taking advantage of that. I don't know what else, Peter, about
Well,
that.
let me add to that. When you talk about the younger generation, I think they're also just much more skeptical in general about finance in some ways. Certainly my experience. So one of the things that we like to do with each edition is really connect it to current events in finance, things that they're hearing about, especially debates that they're hearing about. So some of the things that we've made sure to include in the new edition are a section on how to think about meme stocks and crypto. What are the role of short sellers, and how are they important in markets? What is their function in markets, and how should we think about that? Another debate certainly that gets a lot of play in the U.S. From U.S. politicians is a lot of discussion around share repurchases, and are share repurchases good or bad? And a lot of myths around that regulators and politicians seem to misunderstand what share repurchases are. And so trying to bring those debates a bit to life in the textbook and give students really kind of the foundations and principles so that they can think through these issues on their own. In the future, obviously, there'll be new issues that they're going to confront in coming years, but so that they have the ability to think through those issues on their own and feel that they can come to a clear-eyed assessment rather than just listening to what politicians or the news media has to say about it. So that's, I think, important. Some other topics we cover in the book and think through are SPACs, which were another kind of big phenomenon in the U.S. in the past couple of years. So we try to keep it alive with those important examples that they're hearing about that get a lot of play, get a lot of attention, but often there's a lot of misinformation about. And I think in some sense it's easiest to learn from the mistakes that people have made sometimes, and understanding what was involved in those errors can really help clarify things for students.
Yeah, I think the share repurchases examples, I think, is a wonderful example of how you can make finance and the way we approach finance come to life. Basically, if you understand the basic idea, the absence of arbitrage, then and you use that as the unifying principle in the class, then if you talk about a share repurchase, you can immediately make the argument, look, I can take a share repurchase and turn it into a dividend if I want, right? Or I could turn a dividend into a share repurchase. And so these two things can't be fundamentally different. And so you can take a debate that looks somewhat opaque in the newspaper and show students how, using the principles of finance, they can clarify the issue. I think that's a wonderful example of using it. But so Peter and I were thinking, when we were thinking about this webinar, how could we illustrate other, a really topical example? And so I think the example to do that with is the example of the banking crisis in the United States, the banking crisis at Silicon Valley Bank. So
yeah, certainly in the news. It's certainly in the news here a lot, as you can imagine. I'm sure around the world as well. So Silicon Valley Bank, being the largest kind of bank failure in the U.S. since the financial crisis, and a lot of fallout that's continuing from that. And especially where I am sitting at Stanford, it's gotten extra attention here, especially from our students, many of them who had accounts at Silicon Valley Bank. So it was a pretty dramatic time. But it is useful because I think students are easily confused about just what a bank is, first of all. What is it that banks do? And then, how can they get in trouble? And there's different ways that banks can get in trouble. And this one wasn't maybe the usual one, I guess, or is the usual one, depending on the perspective from history that you want to take. So I usually start, and Jonathan's going to criticize me because he hates seeing my slides, but I usually like to start by setting it up briefly with what's a bank for students, and start with the basics. The idea that a bank takes in deposits mostly and a little bit of equity, and then uses that money to lend, to hold some in cash, but lends by buying government bonds, by buying mortgage-backed securities, making loans, and so forth. And that, in this process, the way banks generally make money is, they put in a little bit of capital of their own. That bank equity is their capital, and then they make money by trying to earn more on those loans than they're paying on their deposits. And given all the leverage, that can turn into a pretty attractive ROE. So that's kind of the basic business of a bank, and it's useful to kind of show this to students, because they often don't immediately understand that deposits are really the bank, is a lot of leverage. It's the bank taking on leverage. That it's basically a very levered investment that the firm is making. So that's a useful perspective to start out with, because then it kind of leads to a lot of other conversations you can have about just the general corporate finance context around leverage and capital structure, and what does that mean? Why does it change returns? But also, what does it do to risk, and so forth. So that's, I like to start.
Yeah, and let me just say, let's take one step back here. The way, so let's imagine you're in the classroom and the Silicon Bank, and you're teaching core finance, and Silicon Bank fails, and the students walk into the classroom. This is your opportunity to show, hey, we can take your knowledge and you can understand what's going on better than most newspaper articles on the question. And so, this is a golden opportunity. So as you say, maybe you put a slide up, put this up, and you start with the question, what is a bank? And so then students are thinking.
It's a very levered firm.
A very levered firm, right? And so now all the issues that you've been teaching over the course of the quarter.
Yeah. Now, I would say, the next thing that a lot of people think about when they think about a bank is, well, how do banks fail? Well, they make bad loans, right? So they make loans that don't get repaid. They make bad investments. That's not exactly the case here. These, the government bonds, the loans they made are all fine. So then students are a little confused. Well, how do I get in trouble if I'm making these really good loans and nothing's turned sour on that side, on the asset side. And so then we talk a little bit about, what's the other problem that banks can have, right? The other problem is that this leverage is very short term, the deposits are very short term, but the duration, the average maturity of the loans they're making are generally longer term, and it's about this duration mismatch. And that's the exposure. And then kind of let them sit with that and try to understand, okay, what does that mean? What risk then does that expose the bank to? And see if some students can intuit it once they've just thought through this basic fact about many banks.
Well, I would say Peter and I obviously don't teach the course the same way. I would say it differently. I would say to students, what do banks do? I would say, well, they issue mortgages. Okay, and the question is, what happens to the value of a mortgage when interest rates change? That's a question. And so this is actually, when we designed the 6th edition, we obviously didn't know that Silicon Valley Bank was going to fail, but it turns out that some of the things we did in the 6th edition make it very easy to make this question easy to understand from the student's perspective. So the first question you'd have to ask students would ask at this point is, interest rates change. What does that mean, interest rates change? So let's start with one of our tools to show them what it means for interest rates to change.
Sure. Let me actually bring up the tool that Jonathan's talking about. So we have a bunch of interactive tools in the textbook, and the one he's talking about is our dynamic yield curve tool. So let me just pull that up and show you what that looks like. Jonathan, can you see my screen okay?
Yeah.
Okay, perfect. So this tool allows you to see the yield curve at different points in time. That's shown on the left. On the right, we can look at different macroeconomic statistics. So for example, here I'm looking at US housing starts recently. And I have to apologize for a very noisy dog in the background. I'm probably gonna have to get up and close the door in a second. You can see low interest rates that we had in 2020, in November of 2020. And, you know, basically it's zero in the US until you get to these longer maturities. Now, what we can do is then see how the yield curve changed over time. And you can see, let me just play that forward. Interest rates stayed low during the crisis, but then let me pause and back up, and you can see, of course, the rapid increase we've had in interest rates over 2022, getting until March of 2022. So, what the yield curve tool allows us to do is kind of look at different points in time and see how that yield curve was actually changing, was evolving against these different macroeconomic series. I'm going to shut the door, Jonathan, because of my noisy dog, but why don't you talk for a moment?
Okay. But I mean, so from the perspective of teaching, you can basically show what it means for interest rates to change. You can show the picture of, there are two issues here. There's the shape of the yield curve, and there's the overall level of rates. And what you can see in this, in what you can demonstrate with this, what happened in the last 2 years is rates were very low. But even when they were low, the yield curve was upward sloping. So banks were issuing long-dated liabilities and getting a high rate relative to the very low rate they were getting on deposits. So life was good back then. And then suddenly the world changed. Now we're in a world where the yield curve is pretty flat, and and the rates are much higher. And so the question now is, what happens to that entity we call a bank, which has deposits which are very, very short term and liabilities that are very long term? What would happen to that? And so now we can start talking about, well, what happened to Silicon Valley Bank?
Yeah. Now, before we leave this tool, let me just highlight a couple things about it. Obviously, you can see, we can go back to the 1990. We can see the different recessions in the US. And one thing that is also useful to do, and I also walk students through about how, in some sense, a lot of this was predictable, right? That in slow times and recessions, we do have the flat yield curve, which is very steep coming out of the recession, but then often rates re-equilibrate and so forth. And so you can go back as well over similar episodes back in the early 90s, et cetera, and see that these similar patterns played out. The other thing I was going to mention here is it's kind of fun to look at how interest rates move with different macroeconomic series. So other things you can look at are, for example, how is corporate investment changing over the business cycle? What are high yield bond spreads doing? What's happening to home prices, inflation, GDP, the stock market, et cetera. So it's kind of a nice tool to just talk about different episodes from a historical perspective and how they relate to what's currently happening in the market today. And again, that's all built into the textbook. Okay, so let's go to Jonathan's question though. So what happens to a mortgage when interest rates rise? So for that, let me pull up the other tool Jonathan was mentioning. That's our annuity calculator, which we use a lot in finance. I'm sure many of you do as well. But this is kind of our version of it. And it's a standard type of annuity calculator. So, often, we'll just use it to do a basic mortgage problem. Let's see, let's go to a mortgage in the US that Silicon Valley Bank had many of that were written at around 3% rates, 3% annual rate. I'll put that on monthly terms and change it to 360 months for the mortgage. And let's borrow $100,000 and see what that monthly payment is on $100,000. So $421 payment. And so this is just standard annuity calculator. Let students do those calculations again, right within the context of the book as well. And we do a lot of examples with it in the book. On the right-hand side, by the way, shows just the amortization table. We can go, for example, let's go to the end and see after 30 years how at the final payments we've paid down the principal. And if we click on any payment here, we can also see how much principal was paid up until that point, how much was paid in interest up until that point, and so forth. So it provides all of that standard information, but also kind of walks them through the calculations that they would do to do this assessment on their own. So what is the basic annuity formula that's being used to calculate this? How would they set that up? And in addition, if they're using Excel, how would they do the same thing in Excel? So it gives them that information. Also, if they want to use a spreadsheet tool to do these types of calculations. So that's the basic annuity calculator. But let's talk about the question at hand, which is what happens now when interest rates went from 3% annualized to 6% annualized, which is essentially what happened over the course of a few months here in the US. And so we'll change that rate, that discount rate on the loan. And let's take a look at the present value, the new present value, and it's dropped to 70. So from 100 to 70 in a few months. So then we ask students what that means for the bank.
And, so obviously they can see the deposits are unaffected by interest rates since they're such short term. The liability goes down by 30%. You can see how a bank will get into trouble even if the mortgage is guaranteed by the government, or even if it's a AAA mortgage. It's not a default risk that's causing the problem here. It's interest rate mismatch that's causing the problem here. And then you could have a discussion how regulators could have missed this. Astonishingly, the stress tests did not include this scenario when they were evaluating the riskiness of these banks.
Yeah, no, well, just some U.S.-centric things on that. First of all, Silicon Valley Bank wasn't regulated as a large bank, partly because they had lobbied to get the threshold raised from 50 billion to 250 billion before they crossed the 50 billion threshold, so that they weren't regulated as a large bank. But even the large banks in the U.S., the systemically important banks, when you looked at the stress test that they did over the past year, they were all around what happens if unemployment goes up and interest rates fall, not what happens if interest rates rise, even though that was probably the most important scenario on the horizon. So yeah, it's unfortunately the case. And as Morris mentions in the chat, yes, we have the same similar issues with recent failure of Credit Suisse and so forth. So,
and I think just to sum things up, we of course didn't make these online tools with the purposes of evaluating Silicon Valley Bank, but I think the fact that you can so easily do it is indication that the basic tools of finance really can be brought into the classroom and it can be informative about current events. And the extent to which you can do that in the classroom really, I think, makes finance come to life and takes, where many students are intimidated or they're bored or whatever, and really brings it home why what they're studying isn't just for the final grade, but really important stuff that can help them understand the world around them.
Graham asked a question in the chat as to whether we have the students do a lot of calculations on our exams, given that most of these things are automated in practice. And I would say that at least at Stanford, in our exams, we tend to allow them to use Excel or other calculator tools. So the questions are much more conceptually focused on sort of what's the impact, what's the meaning, as opposed to doing just the specific calculation itself. Or, of course, and using the formula in the right way. So they need to know how to use the calculations in the right way, but we're letting them use Excel or other calculators on exams. That varies obviously by institution, but just to answer Graham's question from our perspective.
I believe very
Jonathan,
strongly.
you teach a bit different type of course. You might talk a little bit about your course and how that works.
Yeah. So I teach a flipped classroom, but there, and I feel very strongly that the only way you can keep students engaged is if you give them questions that are practical and conceptual, and not have them do rote work with formulas. Of course, that said, it's always disappointing. There's always a fraction of students that couldn't care less, which is always disappointing. But there's a lot to be said for the ones that care and the ones that come back afterwards. Peter will talk about this at Stanford. There were actually some students. We actually have an exercise that we do in the core class, which is funnily enough, it was exactly this exercise. We do an exercise where we have a conceptual bank, we change interest rates, and we ask what happens to the equity value of the bank. And then we do that early on when we're doing mortgages and annuities and everything. And it was great to have students actually come back and talk to us and say, "My God, you were doing it in the third week of classes. What the hell was happening with regulators?" And me saying, "Yeah, I know. I don't know what was happening with regulators."
There's something happening with your camera there. Yeah, no, that's right. So just going back to kind of finish the point on Silicon Valley Bank and we did. Jonathan is exactly right. In week 3 of the standard course that we teach here, we do an example. Actually, we used to talk about it in the context of the S&L crisis, the savings and loan crisis in the United States, which is a little bit back in history for most students. And so they'd be like, "Oh, okay, so that problem sort of solved." The idea, of course, that if you're losing 30% on your mortgages and you only have 7.5% in equity here, that your equity is going to get wiped out. We talk about how banks should be hedging that risk and other strategies they can do to manage that risk. And so we did have a lot of students call us up in the last few weeks saying, "Wait a second, you taught us this right from the get-go when we studied finance. How come A, Silicon Valley Bank didn't understand this, and B, the regulators didn't understand this and didn't catch it in time?" So it is a little bit mysterious there. Although I will say on that point, they were hedging until the early 2022. They took off their hedges in early 2022, right when interest rates really started to take off. So we can talk about that as well, and sort of what debt overhang can imply. Lots of good corporate finance discussions that can come from that. So, all right. So Jonathan, should we talk a little bit about just kind of switching gears a little bit, talk a little bit about stocks and portfolios and things like that? Or
yeah, so why don't we talk about some of the other tools we have, and people can think about their own way of integrating those tools into their lectures.
Great. So yeah, so one of the things that we have a whole set of tools related to evaluating the risk of stocks. And so let me just kind of pull up a picture that we'll come back to in a moment, but let me switch what I'm sharing. So go back to this. Okay. I think you can see it now. And so, obviously a key thing that we teach in the first finance course is CAPM and optimal portfolio construction and the relationship between the security market line and the capital market line. Kind of standard pictures that I'm sure you've all seen before. But I want to sort of, first of all, step back and talk about how we build up to that a little bit, and then talk about as well this tool that we have that allows you to pull in current data and see what things look like from the perspective of current data. So the other tool I was going to mention here is our portfolio optimization tool that just kind of helps illustrate the basic idea of portfolio construction and how we optimize a portfolio, starting with just 2 stocks. And so this is the usual picture of 2 stocks. We've got volatility, we have expected return, and then we can think of portfolios of those 2 stocks and look at those different combinations that we get and the impact on both risk and return as we change the mix across the 2 stocks. So that's the starting point usually. Like to talk to students a little bit about how correlation impacts that. And, the more correlated the stocks are, the more diversification we can get. If they're completely correlated with each other, we don't get any diversification. But even, we can get quite a bit of diversification in almost every other circumstance. So that's a nice picture to start with. We can then add in short sales and talk about, how do short sales work and which stock would you want to short sell in this situation and why, and what would be the potential benefits from doing that, and how that changes the options in the portfolio, and they can see sort of what the different expected returns and volatilities are that arise from that. And then, we like to talk about what happens if I can borrow and lend and add that to the picture, and then look at which portfolio I'm going to combine with borrow and lending and how that changes the risk return trade-offs, and convince them that, well, really what we care about is the slope of this line. We want to maximize the slope or the Sharpe ratio, and of course find the point of tangency, which we can then illustrate here. And so that's just kind of a quick demo that they can play around with and really kind of get that concept and understand why there is just a single portfolio that they would want to combine with risk-free investments in order to optimize and maximize that Sharpe ratio. So
yes, and let me just say that when we teach this, we let the students play with it as well. It's important, I think, for them, to intuitively understand what's going on, to force them to play with it themselves, and let them come to the realization without telling them that we want to maximize that Sharpe ratio. We want that tangency portfolio.
Mm-hmm. Yeah, exactly. Well, once we've got them kind of on board and we've sort of talked about it in the abstract, it's fun to sort of pull up some data and let them look at some data. So let me go back to that other tool I showed you. This is a tool that we have that allows you to pull in, real-time stock data. See, for example, Nike stock, what its historical volatility and return has been, estimate its beta, and so forth. So let me just add another stock to this list. Let me see what I've got here already. Let's add in, I don't know, Campbell Soup. And we'll add in Campbell Soup. So we'll talk about, what's a stock that might have a low beta, and why would Campbell Soup have a low beta? And we pull it in and you can see right away the measurement of its beta, about 0.34. And we can drill down on that for Campbell Soup. So if I go to the beta analysis tab and look at, we can see here, let me just blow that up, the regression analysis for Campbell Soup. So this is just showing Campbell Soup market excess returns versus Campbell Soup excess returns. They can see that best fitting regression line and the beta of 0.34 for Campbell Soup. So as you're introducing these topics, talking about them in the abstract, it's really fun. It's really useful to pull up some companies that they're familiar with, have them try to guess, oh, is that going to be high beta or low beta? And then you can pull in the data and actually take a look at it and analyze it right there. So that's really effective tool that we like to use in the classroom. And then let me just go to, there's a lot of other things you can do in this tool, but let me just go to that slide I was showing before, which is now that we've pulled in a bunch of stocks, so these are all different ones we've pulled into the tool, we can see, okay, using these stocks, what is the portfolio frontier I could get with these stocks? And let me just zoom in on that a little bit. And this dot out here, you can see is the S&P 500. This is the best portfolio I can get with these stocks. It falls short in terms of Sharpe rate of the S&P 500. We could talk about why. Well, because while we can diversify quite a bit with these 9 stocks, we can't get as much diversification as there is in the S&P 500, and kind of walk through that a little bit. But as we add more stocks, we can do better and better. This is the picture that you get, and if you wanted to get as close as you could in terms of the maximal Sharpe ratio, we also show them the portfolio allocation that you would take. This is the portfolio allocation just using these 9 stocks. So this would be what gets you the closest to the S&P in terms of Sharpe ratio, just using these 9 stocks. Now, one thing that's fun to do is ask the students, well, given that we're assuming these stocks, currently we're assuming they're going to earn their CAPM returns. If I added as an additional option to this investor, what if they could invest in the S&P 500? How would their portfolio allocation change? And have them think about that for a minute, but then we're going to do that. So let me go back here and turn on, let them invest in the S&P 500. And if I do that, oops, it's going to reload things. And now if I look at the optimal portfolio allocation below, interestingly enough, we're putting all our money in the S&P, right? Because if there's no alpha, there's no extra return, if they're all earning their CAPM returns, and there's nothing better than we can do than just putting all our money in the market. And they see that very clearly all of a sudden. Once that becomes an option, we're putting all our money in the market and nothing in these other stocks we have there.
You know, one of the things to do next, again, to try to engage students, because you know, there's students when you teach this who are sitting there going, fine, 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 but I made all my money by picking stocks. And so to try to get those, you know, try to engage those students, you could ask them the question, okay, let's assume, and let's leave aside the question how they work, whether this is true, but let's assume you guys think that there's a good buy, and you also agree that that you should try to lower the variance of your portfolio. How should you go about doing that?
Yeah, let's take a look at that. So let's pick a stock. Well, a lot of you know, Nike is a stock that's near and dear to our hearts at Stanford because Phil Knight's a big donor at GSB. So let's pick Nike stock, and let's say some student says, well, you know, I think it's going to do a little bit better than what you predicted here in your analysis. So we're going to increase it by a percentage point. And let's take a look at what that does if we do that. Oops, let me do that again. Let me just update based on that. So now what you can see is we're assuming that Nike is no longer on the security market line, but it's a bit above. It's got some alpha. It's got a higher return than would be predicted by the CAPM, and so that will mean you'd want to invest a bit in Nike, right? You would probably think about deviating in your portfolio. We can actually look at that in the context now of the portfolio allocation and see what happens. In this case, you do start to put some of your money in Nike, but you're still maintaining a pretty well diversified, still 88% in the market. And by the way, when you're investing in Nike, maybe you're going to shift some of your investments in these other stocks because you also might be hedging some of that position now, that long position you're taking in Nike once you deviate from the overall market strategy. We can talk about, you know, why that would be and how you still want to try to optimize. Even if you're taking a position, taking a bet, you don't want to go all in, and you may want to think about how you're going to hedge that bet using some other instruments as well.
Yeah, we find this really, especially for those students that are you know, doubtful about diversification and everything. This is a nice exercise because it gets them thinking. Okay, yeah, okay, great. I you know, I'm going to bet on Nike, but you know, I don't want to put all my wealth in Nike. And how would I do that in a way that would still lower the variance of my portfolio?
Mm-hmm. Great.
You know, the one thing we should talk about too, Peter, is the tool that allows you to look at data of individual companies, look at various things. I think that's also really engaging tool.
Yeah, that's our industry metrics tool. So let me talk about the industry metrics tool. So and pull that up. This also allows you to use live data in the classroom in a variety of ways. Let me just explain a little bit what the panel here on the left and what you can do. So here we can pick an industry. We could pick a sector. I picked consumer staples. We could also just look at all stocks if we wanted. So we could look at all stocks. But that's the first choice if you want to look at an industry or sector. And then I can choose different financial metrics to look at. So right now I have it on leverage, but let's actually start with something simpler. Let's start with something like gross margins and look at what are gross margins in the consumer staples sector. And I'll focus on, I can look at small, medium, large, or all stocks. I'll look at large cap stocks. So large cap consumer staple stocks. And you can see here, typical gross margins are between about 10% and up to around 60%. And you can see that histogram of stocks and their margins. You can also see the points here are showing you the cumulative. Let me turn off the histogram for a moment. This is the cumulative distribution. I can see the ranking of individual stocks. So just as an example, what are some of the high margin ones we see here? So Brown-Forman, who's a distiller, they have high margins. Coca-Cola has very high margins, gross margins. On the other hand, what are some of the, the lower margin ones? Costco, for example, is a very low margin retailer in the US. Tyson Foods, and so forth. So they get Hormel Foods. So they can see, you know, what are some stocks that have high margins, what are some stocks that have low margins, and see also just that range across this sector and the amount of variation there is. So that's just an example of one metric that we can look at and look at some of the individual stocks involved. Let's take a look at some other metrics. We can look at EBIT margins or operating margins as well. And here we can see, obviously, that's a little bit lower, goes down to about 2% or so at the very low end. So Walgreens, as an example of a very low EBIT margin right now. And again, you know, Monster Beverage, Coca-Cola, some of those high EBIT margins. So we can look at, again, different operating statistics. You can look at, for example, as well, we can look at inventory or other net working capital statistics, accounts receivables, accounts payables, inventory. Let's just take a look at inventory for a moment. You could see that for these firms, the range is at the low end around 22 days worth of inventory. At the high end, you know, about 200 days worth of inventory. We can guess that those might be, that's, yeah, so we can see sort of which are the stocks there. So in any case, you can look across the range and see what some of those differences are. Let's go down to some that are kind of more on the finance side. So we can look at things like interest coverage. We can look at what I was showing before was debt to enterprise value, so net debt to total enterprise value. And here you can see that, you know, here are firms that are in, you know, all in consumer staples, but the range of leverage goes from about 0, so no debt whatsoever. That's Costco, all the way up to around 40% leverage. Let's take a look at Molson Coors, for example, is at 40% leverage. And so you can see a big range of leverage across these different firms. And then that can lead into a useful conversation about, you know, why might firms be choosing different leverage? What are the benefits of different amounts of leverage that they might choose? Does it impact their cost of capital? Why or why not? But it's a very useful starting point for that conversation.
That's not a bad place to talk about some of the other to interact.
I lost your audio for a second, Jonathan. I don't know if other people can hear.
Analyze a firm. We analyze the debt equity decision in the perfect market setting.
Yes, you're talking about the Modigliani Miller tool, which I have here as well. So Jonathan's talking about the fact that, you know, when we teach about capital structure, we often, I'm sure all of us start with talking about Modigliani Miller and what are the implications in perfect capital markets for the cost of capital. And so this one's a little complicated. It takes a little build up, but let me just explain what we're doing with this tool and what it's showing. So what we have in the top right here is a probability distribution of the value of the firm, let's say 1 year in the future. And then the red line is showing the debt level that the firm has. So let me put it really low for a moment. Let me put it way down here. So if I have very little debt on this firm, you can see almost always it's going to have a value that's enough to pay off that debt. So the probability default is very low, 0.3%. And at this low debt level of $34 million. And what the bottom axis is showing is, and what we can see also in this table at the bottom, is what's happening to the cost of capital of the firm's debt and equity as we vary the amount of leverage. So this is a case where the risk-free rate is 4%. You can see the debt's trading just above that risk-free rate at 4.02%. So, you know, it's got a tiny bit of risk there. The equity cost of capital is 12.9%, and then the weighted average cost of capital is 10% once we take the weights between those. And that's shown in this graph on the right. The red line is the equity cost of capital, the blue line is the debt cost of capital, and the green line is the weighted average cost of capital. And then what we can show is how what happens is we change the amount of leverage. So if we increase debt, let's raise it to 50, you can see the cost of debt goes up. The cost of equity also goes up, right? Because the equity is getting riskier as well, but that weighted average cost of capital, in fact, doesn't change.
This is one of the hardest things to teach, I think. And so you know, Peter's showing the security market line piece where we try to show that even though the cost of debt is going up and the cost of equity is going up, the weighted average cost of capital stays the same.
Yeah, exactly. So we made a graphic that that kind of illustrates those, both the weights and the risk in the same chart. So let me just kind of explain what this chart is showing. So this chart is showing the beta. The blue is the debt and the red is the equity. Debt's beta is close to 0. The equity beta is getting pushed up as we lever up the firm. Right now, they're, you know, roughly, you know, pretty similar weights between the two. And the weighted average cost of capital has a beta of 1. So the firm itself, the overall weighted average cost of capital is consistent with a beta of 1. Now, as we increase debt, what's going to happen is the equity is going to get riskier. So its beta goes up, but it's shrinking, its weight is shrinking compared to the debt. And so that weight, the balancing point is staying the same even as I increase debt. So let me make it very highly levered here. Whoops, maybe that's a little too high to see. Let me back it off just a little bit. Not letting me back it up. But now you can see is most of the weight's in the debt. Equity super risky, has a beta of 5, but has a very tiny weight on it because this is almost all debt financed firms. So so that's the idea, and you can play around with this and see how things change as we kind of change the debt of the firm. Let me just go back to sort of that intermediate case. So there you have it. That's our Modigliani-Miller tool. It can, again, be fun for students to see how those numbers are going to change and match their intuition as they think about different capital structures. Obviously, that would then lead into, okay, well, what are the potential benefits of leverage and how might a firm choose its leverage beyond that? But that's a useful starting point to get everyone on the same page. We always find that the perfect markets framework is always a key starting point for any of these conversations.
Maybe we should see if there are any audience questions at this point.
Yeah, great idea. So, well, thanks also for your patience, those who are still out there and still with us. We'd love to hear some questions. Go ahead and type them in the chat or unmute, and be happy to answer any that we
There was one question about if these tools will replace the Pearson financial calculator, but basically it will stay. But these are just not just, but these are complement tools. These will complement tools like the financial calculator. But we
That's
have
right.
some if nobody is asking any questions, we have some pre-submitted questions. Well, if you do have any questions, I'm talking to the audience now. Please either.
Please go ahead. We're happy to hear
Yes.
from some of you. So
In the meantime, maybe we
the time.
can bring up the dashboard just to mention the other tools we have.
Mm-hmm.
So what do we have a compound interest tool that'll show you, you know, how interest compounds over time. It'll divide into the simple interest and the interest on interest. And
the MPV profile tool that's
okay.
for illustrating IRRs and multiple IRRs and so forth. Yeah, so a bunch of these great tools we hope you'll play around with. You can also feel free to reach out to the organizer of the webinar. They'll be providing information if you want to start trying these tools right away. We'd love your feedback on them. So please go ahead and reach out to us if you'd be interested in demoing any of the tools, and they are part of the 6th edition of the book as well. So.
Yeah, so maybe we could answer, or you could answer a few questions about which were pre-submitted, and most of these are around a very similar topic, which is engagement. So the main question is, what do you think is the best way to better engage students who are either not very interested in the topic, or how do you make the topics more attractive to Gen Z? And also how to engage students' perseverance in working with interactive online tools proactively.
Yeah, no, it's a great question. And I think, you know, as we said at the beginning, bringing in things that they're currently hearing about and showing them that they can obtain a deeper understanding about those things. I think that's very motivating for students. So, they once they see that, wait, if I understand this stuff, I can cut through a lot of the noise that I'm hearing and understand these issues in a much better and a much clearer way. I think the students find that very motivating. So, as we said, Silicon Valley Bank is a prime example, a great way to bring it into the classroom. Talking about, the issues that have happened recently in various markets. What is the Federal Reserve trying to accomplish by raising interest rates? How is that changing the cost of capital for many businesses? What are the implications on how they might be rethinking their capital structure choices and so forth? All these things are very, very useful. So we try to bring them in as much as we can, and recognize also, that finance has a lot to say and about how to think about problems. There are things that are still puzzles. There's things that are still mysteries. Meme stocks are not things you can really explain using a discounted cash flow analysis. But that is also a great starting point for a good discussion. What is the fundamental value of these stocks, and why might they depart from those fundamentals for an extended period of time? And what could go wrong?
One of the things that I like to come back to is, I always tell the story that when Peter and I were writing the book, and unfortunately 6 years went by, and we, at the very end, were completely exhausted, didn't want to see another book in our life, another thing in our lives, and the editor said to us, no, you have to write a preface. And Peter and I looked at each other, no way, we have to write more stuff. Anyway, we sat down to write the preface, and we had this insight, and I think this is a pretty important insight, which was finance itself isn't complicated, right? The basic principles of finance are really very simple, absence of arbitrage, etc. What makes finance complicated is there's another set of basic principles that look just as intuitive that are completely wrong. And the hard thing about finance is telling the difference. And, I think that's a pretty important insight. And, the more you're able to take the basic principles and apply them to real world issues that look utterly confusing from the point of view of the popular press that often has the wrong principles. An example of what we do in the introductory course is we'll look for newspaper articles from finance fundies that say exactly the wrong thing. We have an article from an LA Times article telling people they should borrow, they should take a car loan out at a very high interest rate because that will make money even though the deposit rate's very low. And it's a very intuitive argument. Of course, it's all based on the fact that they're ignoring compounding and that kind of stuff and the time value of money. But they would just ignore these things and make a very simple argument that looks right. And then, showing students, look, if you just stick with the basics, you just stick with the basic principles, you can actually see pretty clearly the folly in these arguments. And so, as far as bringing finance to life and making them realize the importance of the simple basic principles that underlie the course, I think that works very effectively.
Yeah, no, I agree with everything that Jonathan said. I think it's really helpful to bring those stories into the classroom, and that's the most powerful thing. And showing them, these are mistakes that people have made in the past. We have one of the features I like most about the book is the common mistake box. Which we have in many of the chapters. Almost every chapter has a common mistake box that sort of shows how people can go wrong in their thinking, and why finance principles can sort of correct those errors. And so that's one of my favorite things.
Thank you. Maybe we have one more question. Time for one more question, if you don't mind. And this is something that everybody talks about these days, and it's ChatGPT. So has it impacted your delivery of teaching, or how do you see the future of finance in the light of ChatGPT?
Yeah, no, that's a great question, and obviously, I mean, currently we've tried it out. It doesn't do a very good job answering our basic finance problems, although it's it's likely to get better and better at that. And so I think it's going to be more and more important for given it's just like Excel, right? Why do students need to learn the underlying formulas if they can compute it in Excel? I think it's important to understand where the formulas come from, but they don't need to be super fast at computing the formulas. They need to know what they mean and how to apply them conceptually in situations that are new. And ChatGPT is not going to be able to do that in the way that students are going to be able to, even as it gets better. So understanding the connections and doing that, 10 years from now, I don't know, I might have a different answer to that question, but at least for the foreseeable future, I think it's really going to emphasize why what's really important about finance is learning how to think through in the right way and think through the fundamentals and the underlying analysis. It's not about the calculations, right? The calculations are kind of a necessary thing, but that's not really what finance is about. It's about how you approach and how you think through the problem.
Yeah, I mean, let's be honest. None of us, even though we say we like change, none of us like change. And I think there's no question ChatGPT is going to change things fundamentally. And how that is, I don't know. But I can't agree more with Peter that if anything, it's going to force us to really test concepts, not rote calculations. And, I view that as a good thing, that to force people to think conceptually. With that said, I think it's going to be very challenging. I think this ChatGPT is going to get exponentially better. I don't know if it's going to plateau, but certainly exponentially better, and it's going to make our exams and homeworks, we're going to have to rethink how we ask those questions, because I think that some more simple questions are going to be easily answerable in the software.
Mm-hmm.
I agree. Probably it will also increase the quality of critical thinking skills, right? In the future. Okay. Yeah. So if there are no more questions from the audience, I think we can finish here. I think we all got very valuable thoughts to take with us today. So thank you very much. Thank you so much for everyone to join and participate. And also special thanks to Emily, Kai, and Daniel from Pearson for your hard work in the background. Of course, big thanks for Jonathan and Peter for joining and sharing your knowledge today. It's been very much appreciated. We'll be in touch with everyone after this in the form of 2 emails, one giving you information on how you can get in touch with someone from Pearson for things like a sample copy of the book, demonstration of MyLab Finance, for example, or consultation. And also, if you'd like to participate in testing some of the tools mentioned today, please contact us by filling the form in the email you will get, hopefully tomorrow. Then there will be a second email a bit later, about within a week, with a link to the recording of today's webinar and some thoughts about what happened today. So thank you very much, everyone, for attending and delivering this webinar, and have a lovely afternoon.
Thank you.